Hey everyone, welcome to another episode of Adam Talks, a podcast that takes an alternative look at retirement. This is Adam Bergman, founder and CEO of IRA Financial. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of Adam Talks. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's episode, I'm going to talk about why death is about to get very expensive. So on August 11, 2021, the Senate approved a $3.5 trillion budget, laying the groundwork for Congress to create legislation increasing taxes on corporations and certain taxpayers, i.e. the wealthy. The budget does not include specific tax increases. So instead, it directs the tax writing Senate Finance Committee, which Senator Wyden of Oregon is the head of, and the House Ways and Means Committee, both run by the Democrats, to reduce the deficit by not less than $1 billion for the period of fiscal years 2022 to 2031. The tax writing committees will determine which specific provisions will be used to raise revenues. And it's going to take time before the details become public. Probably towards early fall, end of summer, early fall is when we're going to start getting more information. So the budget also provides guidance to the tax writing committees in the Senate Finance Committees and the House and Ways Means Committees to focus on certain areas to raise revenues. And guess where the focus will be? Corporate and international tax reform, tax fairness for high-income individuals. They call it tax fairness, but it means increasing taxes. Increased IRS tax enforcement, healthcare savings, and some environmental polluter importer fees. So taxes are coming. That's one thing we could expect. I've talked about this in multiple podcasts in the past. And they're going to be coming in the form of higher income taxes for the wealthy, higher capital gains taxes, which is on the table right now. And President Biden talked about this. He made these proposals public when he was running for office. Over $1 million of capital gains, you're going to pay 40% in capital gains tax for long-term capital gains, which is now taxed at 15 or approximately 20% for certain taxpayers. So 100% increase in some cases, if not more. Yes, there'll be $1 million threshold, but they will be increases. And he also talked about reducing or eliminating the step up in basis, which is what I'm going to spend some time on at the end of this podcast. And that's where the title of this podcast comes from. Death is about to get very expensive, because when you die, and hopefully you don't die for a while, but if you do die in the next few years and your estate's above a certain threshold, guess what? You're going to not only pay estate taxes, but you're also going to pay taxes on the appreciation of those assets. So there'll be no step up in basis for anyone, and there'll be tax. In addition to the estate tax, there'll be a second tax on the asset appreciation, which is definitely extreme. So I'll get to that in 1 minute. I just wanted to spend some time talking about some of the background on how this all is going to work. So the tax writing committees, basically, they can propose their own increasing revenue proposals, but we're looking at potentially they're going to need to increase revenues beyond the $1 billion directed by the budget. President Biden proposed $2.4 trillion in tax increases, so the revenue increase will likely fall somewhere between the $1 billion and the $2.4 trillion. Many experts believe somewhere around $1.3 trillion over a 10-year period. Okay, so they're going to have to find that money somewhere. Generally, it's easier to find it on the rich. They have the money, and less people sympathetic to the rich. So President Biden also made it clear that no one that makes less than $400,000 should feel this increase, although we'll talk about the death tax. That may not be the case. So just again, the corporate tax rate also is something that President Biden talked about during his campaign. He set forth his recommendations for a corporate tax rate to increase from 21 to 28%, and highest income tax rate to move from 37 to 39.6%. It's going to be interesting. We're going to know more in the next few months. What's the next steps? The House of Representatives, they must approve the budget before the congressional committees can act on its directions. So the House is currently out of session until August 23rd, and they'll vote on that when they get back. A vote on the $1.2 trillion bipartisan infrastructure bill, which the Senate approved on August 10th, 2021, is not anticipated until sometimes in the fall. Although some Democrats, they want to vote on the bipartisan infrastructure bill on August 23rd, so the timing on the voting on the infrastructure bill still potentially could be in question, although I'm not sure it's going to get done that particular day, probably in early fall. So let's assume the House approves the budget. The committees are then expected to begin publicly vetting the legislation. It's currently expected that such resulting legislation will be finalized in the fall, and then timing for the vote could basically come thereafter. If not timely passed, the gap funding measure would be required to create more, which can create also more uncertainty. So once the legislation is complete, it can then pass both chambers with the support of a simple majority. That means that it can pass with only congressional Democrats supporting it. The fact that only Democrat support is needed to approve the legislation gives it a better chance of becoming law. But again, nothing's guaranteed. So let's get to the step up in basis, because I think this is the most extreme part of this potential legislation. I've talked about Roth IRA caps, which again, I think is something that probably is going to get in this in order to raise revenues. I do believe you're going to see an increased corporate tax. I think it's going to get to 25. I'm not sure it's going to get to 28. Highest income tax rate will go back to 39%. Capital gains, I'm still not certain that that's going to pass. It's just such an extreme 100% increase from the 20% to 40% for income over $1 million. I'm just not sure it's going to get there. So step up in basis. Okay, May 28, 2021, the Green Book was released, providing clarification to President Biden's American Families Plan. This plan proposed significant changes to how tax basis is calculated on assets gifted or transferred on death. So what is step up in basis? Okay, here's a little refresher. So when people inherit assets, stepped up basis also refers to the step up in basis. Basically, if you have an asset you paid $100,000 for, and when you die it's worth $1 million, your heirs get it at the $1 million basis. That is known as the step up, and that $100,000 to $1 million, that $900,000 of built-in gain is evaporated. It's not recognized, and the heirs receive the asset at the step up in basis. So inherited assets actually have usually gained in value since obviously the deceased purchased them. These capital gains are taxable when the asset is eventually sold by the inheritor, although the step up in basis reduces the tax, right? So if you bought some stock at $100,000, here's another example, and a few years later sold it for $250, you're going to pay tax on the $150. But if you died and you have that stock at 100 and your heirs receive the stock, they'll get a basis of the 250. So when they go sell it for, let's say, 260, they're only going to pay tax on the 10,000 instead of $160,000 in tax. So it's a huge, huge benefit. This provision is enshrined in section 1014 Internal Revenue Code, which states the basis of an inherited asset rises to the fair market value of property at the date of the decedent's death. Basically, again, this means if your child immediately sells a stock, once it receives it, there'll be obviously a reduced to almost zero capital gains on the stepped up basis in assets. So it's a huge, again, tax advantage. Real estate investors, they use the 1031 for the strategy to defer tax until the owner of the real estate dies, and then it goes to the heirs, and they'll get a step up in basis in the asset, and then they can sell it with lower tax. So this is, again, a major, major, major change if this goes through. Based off the American Families Plan, certain donors or deceased owners of appreciated assets would realize capital gains at the time of transfer. Okay, so this is what's going to change. Under the American Families Plan, there'll be no step up in basis. So if you die, okay, and you have assets with a basis that is much lower or lower than the value, the heir will pay or the donor, I should say, will pay tax on that amount. See, the amount of the gain realized would be excess of the asset's fair market value on the date of the gift over the donor's basis. For the decedent, the amount of the gain would be in excess of the asset's fair market value on the date of death over the decedent's basis. Okay, so the proposal does allow $1 million per person, $2 million per married couple exclusion for gains recognition on property transferred by gift or held at death. So that means if you have $600,000, okay, in appreciated assets and you die, there'll be no step up. There'll be no tax or appreciation tax because you'll be under the $1 million. So the Green Book also clarified that the $1 million per person exclusion is in addition to exclusions for property transfers of tangible personal property, transfers to a spouse, transfers to charity, capital gains on certain small business stock, and the current exclusion of $250,000 per person for capital gains on personal residence. Okay, so in sum, the $1 million, the exemption, okay, that $1 million per exclusion is in addition to these following conditions. So if you die and you transfer it to a spouse, just like the current estate tax, there's no estate tax when you transfer property to a spouse. It's only when it goes to the non-spouse heirs. Transfers to charity, okay, that's not going to be subject to the $1 million or the step up in basis. And then the small business stock, which is a huge exclusion, which will help many small businesses get around that. Okay, so that's how the Green Book, at least as it's stated in the Green Book, the step up in basis tax or the change in the step up in basis rules, these categories would be in excess of $1 million. Okay, so it wouldn't count towards $1 million. Again, we don't know what's going to happen. This is just as per the Green Book. The committees could make these changes also. But I know they're very focused on family businesses and family farms, because think about it. If you have a dry cleaning business or a restaurant, you have probably a very low basis. Let's say you put in a few $100,000, and maybe now it's worth a few $1 million, maybe $2-3 million in revenue, pretty successful restaurant. You die, God forbid, if you don't have a spouse and it goes to a non-spouse, that $1 million exemption, but then anything above that $1 million would be subject to a capital gains tax, which we know could be approximately 40% on capital gains over $1 million. So you're going to pay the capital gains tax. Now, if you're a small restaurant, where are you going to get the money, right? Let's say you owe 40% on $100,000. That's $400,000. Where are you getting the money? Okay, so there's going to be some rules in terms of, hey, if you pass it to a family member or if it's a farm, you don't have to pay that tax until you sell the business. There's going to be all these rules that hopefully will clarify how the procedures work, but basically it's going to be a mess. Okay, this is something new. It's going to be an absolute mess. Same with trusts or small businesses. It's going to be the same rules for revocable trusts. The $1 million exemption will apply, and then there'll be a tax on anything above that. What else? So how much is this going to raise? What the hell is the point of this? Well, they claim it's going to raise $110 billion over 10 years. This including the increase in tax to 39.6 for the high income earners and nixing the step up in basis. They expect that to generate $110 billion over 10 years. Again, Congress will ultimately decide which is going to be law. Again, I'm not sure the step up in basis gets in. It's super extreme. The step up in basis has been in the tax code for a long time. Again, in section 1014. I just I can't believe that something like this could become law, but who knows? I mean, crazier things have happened. We see there's big momentum now to pay for this infrastructure bill, and they need to raise revenues. And again, they feel like this is a good way to do it. Now, there's going to be solutions, right? I got a few off the top of my head. It's pretty simple stuff. Irrevocable trust, right? Irrevocable trust, what people are going to do, something called a slat. It's basically a type of trust. It's a gift from one spouse to an irrevocable trust for the benefit of the other spouse. You basically transfer in business stock into the slat, and it gets out of your estate. Okay, and this is just, I'm not an estate and trust lawyer, but just talking to a few, they're already cooking up solutions to get around the step up in basis and the estate tax. Again, right now the exclusion is about 11.7 million. We don't know where the exclusion will go in the next few years. It could go down to 5 million. So what they want to do is nix the step up in basis, tax you, and then have a lower threshold so that you're going to be paying estate tax and potentially a capital gain tax of 40%. So they're going to get 90% of your money. I mean, some of this stuff doesn't make sense. So if you have an estate of $20 million, and let's say a lot of it's tied into business appreciation, you're going to pay 40% tax on anything over $1 million, and potentially 50% tax on anything over, let's say, 5 or 10 million. They're going to take a lot of the money at death. So yeah, we'll see what shakes out. I do think there's a chance this nixing the step up in basis gets in, but their solution, the SLAT's one of them, right? You're going to see a lot of people putting their business at lower values in an irrevocable trust, taking advantage of the estate tax exemption. Life insurance will be another one. Life insurance seems to be outside of the estate tax, so you'll be seeing people put more money in life insurance and irrevocable trusts. And again, there are some exclusions according to this green book to the $1 million threshold, like small business stock. So if you have a small business, you've held it more than 5 years, there's ways that you can get around capital gains tax on the sale. So again, there'll be some tools to circumvent these or this nixing of the step up in basis guarantee, specifically again tied into irrevocable trust and small business stock, things like that. But it's going to change the way people do business. It could, I think, have a negative impact on capital appreciation and capital investments into small businesses. The small business stock exclusion, hopefully that stays in because that will help many small investors. Again, and there's exclusions. You got to be under $50 million. You have to hold the stock at least 5 years. So it's going to help smaller businesses, but not larger ones where, let's say you invest in a startup and it turns out that it grows and now it's a valuation of $400 million and you own a percentage of it and that's over $1 million, and you die, you're going to lose your step up. Your heirs will pay tax on it and potentially estate tax as well. So when I say tax, I mean the donor. The heirs never pay tax, right? It's always your estate will pay the tax, but it's less money in their pocket. So, indirectly they're paying it as well. So death will get very expensive. What happens in 4 years if there's a new president, or 3 years if there's a new Congress? I don't know. Things change, right? I do know there's momentum from parts of the Democratic Party to tax more forcefully the wealthy. Again, they promised no one who makes less than $400,000 will see an increase in taxes. We'll see if they keep their promise. But the money's coming from the rich. They got to pay for this this $1 trillion infrastructure bill. They have a $3.5 trillion budget. Now they got to find the money to suck into that budget, and it's coming from the rich. You're going to see it from increased capital gains tax, I think. I hope not, but I do. They definitely increase corporate tax, definitely increase income tax rate. I think you're going to see a Roth cap. You're going to see increased money to the IRS. They're going to increase audits. So they expect this to raise money. Again, there'll be solutions where it could actually backfire because you'll see more money in life insurance. People will be more focused, especially the rich, on estate tax. Now there's $11.7 million exclusion per person. So that's $23 million for a family. Most people don't need to use that. But if that exclusion drops and the step up in basis is nixed, and you have people with small businesses and they're not sure they'll satisfy the small business stock exemption, you'll see people definitely doing some estate planning, trying to figure out a way to make sure that their family doesn't get hit hard with a tax on capital gains tax on assets over, or built-in gains over $1 million. So again, you're looking at not just an estate tax. There's going to be the additional tax on the step up in basis over $1 million with the exclusions, and then also an estate tax. So in a less than, or I should say a hellish type world, you can pay 90% tax or so on the money, right? If you have no estate planning, you have, let's say, $50 million in assets, you have built-in gains, and you're subject to estate tax and subject to 40% tax on the step up in basis. as far as the Green Book suggests, you're going to get hit with an estate tax and a tax on the capital appreciation above the $1 million. So death will get super, super expensive for some. For many of us, it's not going to impact us. Again, if you have less than $400,000 in taxable income, you shouldn't get hit with the increased tax. Although, as I mentioned, you may have $100,000 in taxable income, but significant capital appreciation. A lot of small business owners do not take a lot of salary, right? They put their heart and their soul into their business. They may take under $400,000 in salary, but they may have a business with, I have some friends that started businesses, tech businesses. They put in a few $100,000. It's now worth $20 million, okay? They take salaries of under $300,000. I know that. So what's going to happen? Let's say, God forbid, they die. If they're married, it will go to their spouse without tax. Fine. If they have small business stock, they should be okay from the step up in basis. But if they did no estate planning, they're definitely paying estate tax if they're not married, because if once it goes to a non-heir, you have that $11.7 million exemption, then you're subject to estate tax. Then they're also, if this Biden proposal gets in and they nix the step up in basis, they're going to pay 40% tax on any of the built-in gains over $1 million. So let's say that's $49 million times 40%. And then an estate tax of 50% on the $50 million. So there's not going to be much left. Again, just to be clear, when you die and you leave money to your heir, to your spouse, there's no estate tax, and there doesn't seem to be also a tax on the appreciation over $1 million. That will only kick in when it goes to a non-spouse, like a child. Okay, but there are exemptions that the Green Book presents. Hopefully, they'll also become law, like the small business stock exemption and charity, things like that. So a lot of things to shake up. Just wanted to bring this to your attention. You should, if you have appreciated business stock, you have valuable assets that are appreciating, you should talk to an estate trust attorney. Slats are a really cool way that you can get your business stock into an irrevocable trust, still get income stream during your lifetime, and get the stock out of the estate tax. Life insurance is another great way to get money out of your estate that's not going to be subject to any step-up in basis tax or estate tax. So the committees are going to be hard at work. You're going to be hearing lots of things. Hopefully you're going to be listening or watching me, and I'll keep you guys abreast as soon as the information becomes available. This is some big stuff. And again, I don't want to be political. I got nothing against Democrats, nothing against Republicans. This is just, it is what it is, right? This is what's going on. The Democrats are in control. This is something they're super focused on. Right or wrong, it's not my job. Even if you're against it, there's nothing we can do. How about that? The Democrats control House, Senate, and the presidency. If they want to get it passed, they're going to get it passed. So there's not much we can do other than talk about what it means for us, tax planning, and how we could legally minimize our taxes and keep the money that you work so hard for your family. So I promise I will do my part. Keep listening, subscribe if you haven't. It's going to get bumpy, but we're going to learn a lot more towards September, October, definitely, as to where the committees are coming out. You're going to see they're going to have proposals. They're going to probably request comments from the public, but expect higher corporate tax, higher capital gains tax for certain taxpayer, higher ordinary income tax, cap on the Roth over 5 million, potentially higher, but definitely that's probably something that's going to happen. And then the questionable one is a step up in basis. It's possible, I would say 50-50 at this point, but they expect it to raise significant revenues, and this is something that they've been pushing for. Again, goes back to Senator Warren's wealth tax. This is just all part of the whole idea of taxing wealth on an annual basis. That's been the goal of the progressives for some time. And we'll see how powerful the progressive side of the Democratic Party is versus the more moderate side, and whether all Democrats will go along with this or not. Okay, so it's going to be interesting, bumpy, but we'll see. Okay, so that's what I got for you today. I hope you guys enjoyed the podcast. Stay optimistic. Whatever happens, we'll get through it. There's a lot of smart tax lawyers out there, and we'll figure out ways if you are stuck into this bucket. And there's nothing wrong with being successful, right? That's something I wish some of these Democratic Congress men and women would understand, that that's what makes America great. We all can be successful. It's not a zero-sum game. Work hard, a little luck, American dream. We all can do it. We all can be super rich, which is a great thing, right? It doesn't necessarily need to be a bad thing. So I do think the step up in basis is extreme. It's just one or the other, right? If you want to just deem, like Canada, for example, the way it works, I was born in Canada, I know this. You die, it's a deemed capital gains of death. Essentially 25% of your assets, exclusions, for certain assets like home. But there's no estate tax on top of that, right? You just pay capital gains tax. What they are attempting to do here is add two taxes. A capital gains tax above the $1 million, that's really what's happening. They can call it whatever they want to call it, nixing the step up in basis. It's just a capital gains tax at potentially 40%. Canada's 25%. And then also an estate tax above a certain threshold. So it's definitely extreme, and we'll see what happens. But otherwise, I hope you. I didn't scare anyone. Don't worry. Take a deep breath. It'll get better, and we'll figure out ways through this. So thanks again for listening. Really appreciate you guys, and talk to everyone again next week.